I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight to the burning issues in private markets. Hitting corporate minefields from WeWork to Juul, investors take a hard look at their high private company valuations. Profiting from corporate minefields, investors look to the next spot of opportunity in the wake of growing bankruptcies. And art prices hitting new records, why rebel artist Banksy is proving to be an ironic haven in a tumultuous world. Let's get into some of these burning issues. With me, I am so pleased to say, is Bloomberg's Sonali Basak, Ed Hammond, and Ellen Hewitt. Let's start with you, Sonali. Bank of America sounding the alarm on WeWork and commercial real estate values in general, saying that the potential bankruptcy of WeWork could have a potential real negative impact on commercial real estate values. We're seeing WeWork bond values go down to record lows, implied yields of 12.4%. How realistic is it that this company files for bankruptcy?
Well, think about it. Since the minute they lost their IPO, a bankruptcy has been in the back of people's minds. They would run out of cash in the middle of next year. And so people are talking about a bankruptcy. Unless they raise more money, it's going to be something people continue to talk about. The Harvard researchers that you've alluded to before, they already point out that the lease obligations for 2020 alone are $2.3 billion. And the expenses alone this year so far were $2.9 billion. So you see expenses mounting. It's a very simple game of math here for them to try to recoup that money as they're shedding businesses. Yeah, and so those Harvard Business School study that you did highlight, the researchers there said if the IPO is not successful and the loan agreement is not closed, WeWork is in trouble absent another equity infusion from SoftBank, which, Sonali, leads me to the other question. What are the broader implications for commercial property values more broadly? So the interesting thing that Bank of America analysts realize is that it's not that their loans are very heavily aggregated into CMBS markets. But with that said, they are one of the biggest occupants of New York City real estate, for example, San Francisco. And so do then the properties in the surrounding areas then diminish in value when WeWork is either able to renew their leases or back out of them completely? So that brings me to the next issue. And Ed, one big exit strategy for a lot of companies, and perhaps WeWork was looking for the IPO exit, one big exit has been being purchased by other large corporations. What are we seeing there in terms of the forward-looking appetite for big conglomerates to continue getting bigger? Well, look, I think WeWork is to blame for kind of much ill in the market at the moment, and M&A is suffering partly because of it, because if you look at the effect it's had on valuations and the apparent inability of some of the smartest investors to understand valuations, there is a read-through to that. It is causing a little bit of panic in the market about what stuff is actually worth, and that comes at the back of a huge run-up in M&A values. We've seen premiums push to record highs, but we should note we're coming into the last quarter of the year now, usually the strongest quarter for M&A. I think over the last 5 years, Q4 has traditionally outperformed Qs 1 to 3. So we will probably see some big deals, but they're going to be more of the kind of careful vanilla deals, stuff that makes sense. It's not going to be CEOs going out and doing those sort of very high profile, like we're going to go into a completely different industry and take huge risks. You wrote a recent story that I thought was fascinating about the lessons from some of the big multinational conglomerates of the past. What are those lessons? Well, I think I looked at three conglomerates. So I looked at 3G Capital, obviously the private equity firm that has done a lot in food and beverage. I looked at Valiant, which wasn't a conglomerate so much as a sort of failed experiment in drug making. And then obviously at SoftBank, which is a conglomerate and still, we should note, a successful one. I think there are some comparisons. I think the credulity that the market and to some extent the media has afforded these three is pretty unusual. And I think because of that, they've been allowed to get away with certain things that would have been called out in other companies. And I know particularly there's been sort of some bad governance. All three, if you look at WeWork and Uber under SoftBank, you look at 3G where they just had to restate some accounts, and Valiant is sort of a business case in bad governance. Yeah, thank you. And that also leads me to Ellen, another misvaluation perhaps. Juul, according to reports, Darsana Capital has cut e-cigarette company Juul's valuation by more than a third. Why? What triggered this?
It's hard to say because there's been so much that's happening around Juul in the last couple months. We have, these reports of a mysterious vaping illness, which, while it hasn't been tied directly to Juul, has, I think, increased some of the panic around what we know and what we don't know about the health effects of some of these e-cigarettes and other vaping products. They've also dealt with a lot of regulatory pushback in the last couple months. Inquiries from the CDC, FTC, FDA, state attorneys general. It just kind of continues. And they had their CEO step down recently and be replaced by someone from Altria. And so there have just been a lot of changes at Juul. I think everyone looks at the future of this company and is really unsure whether some major regulatory change might make their future take a huge left turn.
So, Ellen, what is the broader implication for a company like Juul that something very specific, some of these regulatory pressures and pushback have had on the company? Is there a bigger implication?
I think it's just looking at this sort of increasing drumbeat of issues that have been coming up. You know, you've been hearing for the last couple years about concerns that health advocates have about the youth vaping problem. And that was always something that dogged Juul. It was their major issue. You know, they were trying to solve health-related smoking illnesses for adults, but then dealing with this children issue. But then you're seeing in rapid succession when you have regulatory pushback coming multiple times in a short period of time, and I think a health panic around potential ill effects, it's just piling on, and we're starting to see people reassessing the value of that investment.
Ellen, Ed, Shanali, thank you all so much. This all brings us to our next guest, James Gellert, Chairman and Chief Executive Officer of Rapid Ratings, a firm that provides detailed information on the financial health of private companies, ranking them often for the potential risk. James, thank you so much for being with us. You noted that under the surface, that there has been a frothy market conditions that have been building, and there are many ticking time bombs among private companies. Please explain.
Well, a lot of attention is paid to the IPO market and the companies that are really emerging above the surface, if you take the iceberg metaphor. But underneath the surface is a giant market that has had a tremendous influx of capital over the last 10 years in private equity, alternative lenders, a whole variety of members of that asset class now looking at both equity and credit provision to private companies. Because there's been so much, there's been really a chase down the credit curve for yield by those investors, which means more and more capital has been going to weaker and weaker companies that in a more normalized market wouldn't have had access to that much capital.
Do you think that the overvaluation is more prevalent and more extreme in private markets right now than public markets?
Well, I think there's enough to go around, but there's a lot of overvaluation in the private markets, particularly in the segment of it that is really driven by the venture capital community. Because the venture stage companies are funding round after round after round, always looking for higher valuations. When those that are coming into the IPO market are emerging, they tend to have such high and lofty valuations that it's right now we're seeing the public market choke on that.
Do you think that private tech companies are some of the most egregiously highly valued right now?
Well, they are. I mean, there are others, of course. There's a lot in biotech that's highly valued as well. But the tech companies, for certain, you look at the WeWorks, you look at the Pelotons, even some of the ones that came earlier in the year, certainly Uber and Lyft. These are very, very high valuations. And WeWork pulling its deal and the others not performing well are a really good example of how the market reacted.
And there's a lot behind that, you're saying. There's a whole iceberg behind that.
Right. When you go further down, the companies that you don't see as often are the ones that are the 10 to 50 to $100 million revenue companies that are not likely to IPO at any time. And they're being funded by alternative lenders, by banks, community banks, regional banks, sometimes the large banks. And that is a giant market area. And we rate a lot of those companies for our clients who are particularly worried about those companies as members of their supply chain, because upstream they are needing to support them with all sorts of services.
So which companies look like they are fairly or maybe even undervalued within the private markets?
Well, it's very case by case, and I wouldn't look at it from an industry perspective. I'd look at it case by case within industries.
But these are the industries. You did cite some that on average have better than others.
The ones that have really been doing well recently in the last couple of years are forest products, are some of the oil and gas midstream providers, the drillers, the home builders. These are private companies that are underlevered relative to their public peers. They have they've got more efficient asset bases. They're not holding great deals of property like the public home builders are in that sector. And so compared to their public peers, they tend to be between 5 and 10 points on our 100-point scale, better rated than their publics.
A lot to discuss. We'll have to have you back. Thank you so much, James Gellert, Rapid Ratings Chairman and Chief Executive Officer. Coming up, this week's Power Player, Noah Gottdiener, the CEO of Duff & Phelps, who is tired of his colleagues being targeted by lawmakers.
The private equity industry has been used like a piñata by the politicians. And it drives me a bit crazy because I really think that they're a great industry and bring a lot of value.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. This week, I had a chance to sit down with Noah Gottdiener, the CEO and chairman of Duff & Phelps. The firm is a global valuation and corporate finance advisor with a bird's eye view into the thinking of a large cross-section of private equity firms. Gottdiener is a big defender of PE amid a politically fraught backdrop.
There's something attractive about private equity. Look at the public marketplace. There are probably half as many listed companies today as there were a dozen years ago. And there's a reason for that. Because when you're a public company, you really have to be focused on short-term quarterly results. And when you're owned by private equity, you could take a longer-term view.
Although some people say that private equity firms are simply marking the values of some of these companies at higher levels, and then when they choose to go public, you start to see sort of a check on that. And we've seen that with WeWork, we've seen that with Smile Direct, and you know, I just have to wonder, do you think that that's a valid concern, or do you think that it really is much more idiosyncratic than that?
I listen, you know, the examples that you gave with some of these companies, there's definitely been a bit of a sea change. The public markets are looking for a path to profitability. They're no longer interested in companies that don't make money and maybe will never make money. So there's a different lens with regard to what public markets are demanding.
When you talk about private equity and how they really have to do better and provide more value, are there industries right now that seem ripe for embetterment that private equity firms are targeting to go after and get more involved in?
Yeah, the truth is they're looking at opportunities across all industries of the economy. There's some industries that are sort of favorites right now. For example, the manufacturing sector, because there's so much change, and the ability to apply automation to that industry makes it very appealing. But the reality is it's not really about industry. It's about finding energized management teams with a great vision for driving those businesses forward. That's what private equity is looking for.
What's the concern about the political ramifications when you get involved in a sector such as manufacturing, which has certainly been on the front burner when it comes to some of these debates?
Yeah, well, listen, the private equity industry has been used like a piñata by the politicians. And it drives me a bit crazy because I really think that they're a great industry and bring a lot of value. The issue around buying manufacturing firms is, again, that old reputation of private equity firms basically being stripping and dumping the companies that they invested. That happens to some extent today, but that's not really what motivates them today. So they're focused on growing those businesses, on transforming them, and allowing them to thrive in the new economy.
One thing that I know that you've touched on in some of your research is potential consolidation, because there are the winners and there are the losers within the private equity universe, with the outperformers and the underperformers. How big of a consolidation are you expecting?
Well, the industry will continue to consolidate, there's no question, but the way it's going to consolidate, in my view, is around two themes. One, some firms will become global, large capital providers with different types of strategies, capital strategies, and then there will be other firms that won't be as big but will focus on specializing in some way, like industry, for example. So financial service-oriented private equity firms. If you're not in one of those two buckets, you're going to have a tough time. One
sort of notable development that we've seen is, as you mentioned, public markets have been shrinking and fewer companies are choosing to actually have an initial public offering and are doing so later. And I'm wondering whether you think that in some ways this is a trend that will continue with a lot of companies simply choosing to remain private. forever because there seems to be ample capital there and they don't have to deal with the quarterly shareholder reports, et cetera.
Absolutely. I think you will continue to see that for quite some time because the capital is there. It's very liquid. There's always another private equity firm ready to invest in your business if you can articulate the next chapter of growth for your firm. So there's a lot of capital out there, and it's a good well to go to grow your business.
That was my conversation with Noah Gottdiener, the Chief Executive Officer and Chairman of Duff & Phelps. Coming up, a Banksy painting depicting members of the British Parliament as chimpanzees sets a new auction record. We will tell you how much it sold for. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. In the latest issue of Bloomberg Business Week, it focused on the world of private equity. And as you know, the industry has quietly amassed a portfolio valued at more than $4 trillion and has emerged as a force shaping how business plays out around the world. Bloomberg's Jason Kelly wrote a feature for the issue and joins us now. Jason, going forward, how different will the world be for private equity given the absolute enormous amount of cash that they've stockpiled?
Well, it's going to be very different, and I think you're already seeing a lot of those changes, Lisa, in terms of them trying to do deals, put all that money to work, but also the scrutiny that's coming when they do those deals. We're seeing so much chatter in Washington. Your guest just a few minutes ago was talking about that, whether it's from Elizabeth Warren, whether it's from lawmakers, whether it's from regulators all around the world. People are really taking a closer look at where the money's going and maybe more importantly, what private equity is doing to the companies that it owns.
So the private equity executives who you speak with, and I know you speak with a lot of them, I'm wondering how much this shapes what deals they are willing to do and the manner in which they are going to do them, given the regulatory pushback they may face.
I think it's definitely on their minds for certain. It's hard to tell exactly how much it's changing their behavior. One of the things that will be interesting is to see very specifically what the legacy of the Toys R Us deal is. And as you recall, that was a deal where when it went bankrupt, there was a public outcry. KKR and Bain ultimately stepped in and provided severance to the workers or partial severance to the workers who lost their jobs at Toys R Us. So that's one of the proposals that's out there. That's certainly something that people are thinking about is what is private equity's sort of culpability on the other side of a deal that doesn't go right.
Thank you so much, Bloomberg's Jason Kelly. I really appreciate it. Fantastic features throughout the magazine. I recommend everybody pick it up, the Bloomberg Business Week latest edition. Now to the art of investing, where we look at recent standout auctions in the art market. This past week has seen a flurry of multi-million-dollar sales, including one that involved Banksy. Bloomberg's Katya Kazakina joins us now with the details. Katya, before we get into the details of chimpanzees in Parliament, I do want to talk about the broader art market. We have seen an incredible run-up in some of the high-quality art prices over the past decade. Where are we now amid sort of the tumult that we're seeing in the broader geopolitical growth picture?
So it's the fall season, so the auctions are starting. We saw auctions in London and in Hong Kong, where, of course, a lot of tumult is happening. And in general, the market is, on the demand side, seems very strong. On the supply side is a little bit slower. So that's kind of underpinning a lot what's happening right now.
Wait, in other words, people don't want to sell their paintings, but a lot of people want to buy them?
Exactly.
So one thing that I'm wondering is that you hear about, capital restrictions from China, and you hear about slowdowns across the world. That's not affecting the fact that people want to buy art prices?
People are going after sort of the best of the best, right? If they perceive this work or this artist to be a sort of investment grade and in a way bulletproof or highly demanded, and it ranges really from emerging artists, what we've seen in London and in Hong Kong, all the way up to blue chip. If that's the kind of perceived by the market as what it wants, right? there's demand is really surpasses the supply.
So let's take a look at one such painting that was in high demand. This was an auction in Hong Kong. Please tell us about it. It is a cartoon girl. We will put up a picture of it. Here we go. This picture is one that drew, what was it, $25 million?
$25 million.
Okay, so please explain.
So, and mind you, this is happening in Hong Kong during the weekend filled with violent protests and, tear gas filled streets, and this is Sotheby's, very close to that area where it sold $426 million worth of art. So this painting, Yoshitomo Nara, very successful, very sought after Japanese artist. And this is his signature work, iconic image of this sort of cute but somewhat menacing cute character, right? Cartoon character. And it's large. It's one of the largest works that by him that have come up to auction. It's 7 feet, more than 7 feet tall, almost 7 feet wide. So it's kind of an iconic work of his. Now, the market is puzzled, shocked really, because his previous auction record was $5 million. The estimate for this work was $6 million.
Well, another one that sort of defied records was the Banksy painting depicting Parliament as a bunch of chimpanzees amid talk of Brexit. This one sold for, what, $12.2 million?
Exactly. Very timely topic, obviously, in the UK right now, which has also obviously affected the price and the demand for it. The bidding war lasted for 13 minutes. There were 6 bidders. It was crazy watching it. It was totally nuts. And the painting is 14 feet wide. It's like this history painting and satire, of course. So
do we know who bought it?
We don't know yet, but we're going to find out.
Yeah, but
we'll
there were enough people to bid up the value to this level that were interested in this, right?
In this, right. And his previous auction record was £1 million. So again, we see this huge delta in prices. So there's huge demand.
Katya Kazakina, thank you so much for being with us. Katya Kazakina covers the art market for Bloomberg. Now it's time for this week's big number. It centers on the total amount of aggregate debt involved in E&P bankruptcy filings since 2015. It totals $108.9 billion. This is according to the Haynes and Boone recent study, which counted 199 producers that filed for bankruptcy over that time. While the bankruptcies did slow down for a period, you have seen them reaccelerate this year as the price of crude has fallen. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, 1 a.m. in Hong Kong. From New York, this is Bloomberg.